I've said at least that have been pro-Trump and things that I've said that have been anti-Trump.
Welcome to another edition of the Energy Week podcast. Ryan Ray alongside Dr. Energy herself, Ellen Wald. Ellen, how's it going today?
We're doing great. The Celtics won yesterday. The weather is gorgeous. I recovered from the horrible contact dermatitis that I got from doing yard work. So, we're all good.
And before we get into the show, a couple things I need to address. One, I've got some construction going on here in the background where I'm at, so you might hear a little banging and bumping. I'll try to keep my mic muted while I'm not talking to prevent some of that. Two, Ellen, I need to thank you. Ellen was kind enough. We missed last week because we had baby Piper. Ellen sent and her husband sent us baby Piper some gifts. So Ellen, thank you so much for those books. Those are something I'll enjoy getting to read to Piper when she's a little bit more consistent on staying awake. She pretty much sleeps all the time right now. So once she wakes up, I'll be happy to read those lovely books to her. And then finally, Ellen, we don't ask for reviews on this show a lot, but maybe we should, unless they're going to be like this. This came in while the day before my daughter was born. So thank you, sir or ma'am, for leaving this. It means a lot to me. The author of the post is "This Shouldn't Be So Crappy." And the title of the review is called Morons. It's a 1-star review, if you couldn't catch that coming already. And the review itself was right-wing propaganda. And, I thought a lot about that, Ellen. There are definitely things on this show that we've said, or I've said at least, that have been pro-Trump, and things that I've said that have been anti-Trump. At the end of the day, I guess if you listen to this show and you're coming away with right-wing propaganda, I don't know what to tell you, because there's definitely we've questioned the president on multiple things, and I know my stand, and we've had on guests that have openly ridiculed his policy on tariffs and things like that. So the only thing I could figure here is that because we are pro-oil and gas people, that must make us right-wing propagandists. I don't know what else it could be, because anyways, I don't know. It is just, that one kind of caught me off guard there, that right-wing propaganda. So to you, ma'am or sir, I reject your claim. I am propaganda, but of no wing.
Well, I would say that if we were going to be propaganda, I'd at least like to be paid by the right wing for my propaganda.
Thank you.
And so, we're not propagandizing anything, but this is a podcast about oil, gas, other energy, and if that seems right wing, then maybe you need to reorient your right and left political spectrum ideas.
Especially since you're using a computer or cell phone to get on the internet, to get on a website, to type that in. Why don't you go look up where those things come from before you get too much down the right-wing propaganda trail. That would be my closing shot.
Unless you're riding a bike that's connected to your computer and you're physically powering it yourself, you're probably getting
all
that
those plastics come from oil and gas.
That's true.
So yeah. Anyways, so whatever. So anyways, if folks, you want to leave a rating review, I thought we put it out there. It's 5 stars or higher. So please, we'll leave a link to the show notes. Obviously, This Shouldn't Be So Crappy. Terrible name. Don't name your child that, by the way. But This Shouldn't Be So Crappy did not get that memo. So anyways, we'll chug and lug on despite the very, very painful innuendo that I'm a right-wing propagandist. Yes, and I agree, Ellen. We are not getting paid, and so if the Republican National Committee wants to reach out to us, then we would be happy to entertain that. Or Saudis. We're still waiting to call for the Saudis after all the money they got. So okay, let's get into it. We got on Dr. Dean Foreman coming on in a little bit. We'll start with CNBC. Prepare for $80 oil this summer as the wounded bulls rise, RBC warns. It sounds like a movie title, Wounded Bulls. A story about a cowboy and riding a bull. I don't know. Anyways, I was thinking, okay, so summertime, $80 oil. Summertime is what, June, right? That's when summertime officially goes into effect. So we're still...
Well, I think Memorial Day weekend is officially the start of the summer driving season. So that would be like the week before June.
Okay. According to Google, the first day of summer is June 21st. So it depends on the interpretation of what we're talking about here. But anyways, May to June, $80 oil. Ellen, $80 oil just around the corner, according to what we were saying at Memorial Day. That's just a little bit over a month away.
So this is what I found interesting about this article. First of all, is this sentence, which I'm going to read, and if anyone of our listeners out there can actually explain this sentence, I would be very, very grateful. Okay, ready? This is a quote. We see price risk asymmetrically skewed to the upside, spurred by geopolitically infused rallies that could shoot prices toward or even beyond our high-end bull case scenario and test the $80 per barrel mark for intermittent periods this summer. That was RBC strategist Michael Tran, Halima Croft, and Christopher Looney in a research note. Now, correct me if I'm wrong, but asymmetrically skewed, asymmetric and skewed basically mean the same things, right? Something can't be, if it's skewed, then it cannot be symmetrical.
Right.
So I'm really like, I mean, I get part of it that, there might be a geopolitical situation that could cause prices to kind of shoot up to hit 80, but I'm really not sure what a price risk asymmetrically skewed to the upside is. So I was pretty that's a very pretty turn of phrase that I think has absolutely no meaning to it, other than they're saying, things could get hairy this summer depending on what happens geopolitically.
Right, and what is a geopolitically infused rally? What is that exactly?
It's infused. Like, is that like a lavender infused drink or something? Are we cooking now? Is that what we're doing now in the oil market? We're cooking things. We're steeping them.
Well, what would be the things? Let's just just try to parse out what they're saying. What are some of the things we should be looking for, though? I did see this morning that a Republican congressman or senator, I can't remember, maybe from your state, Ellen, Florida, I want to say, is calling for troops in Venezuela. Did I read that right? Is that from Florida? So you got maybe potentially troops in Venezuela. You got the stuff that we're talking about in a minute with Iran. What would be some other events that might infuse the market rally?
Infuse the market rally. So I guess we could have, I don't see the U.S. sending troops to Venezuela as like anything particularly likely, but yeah, I guess so. Or, Russia could invade someone. That could throw oil prices up no matter what. Russia could just invade someone. Syria and Iraq could go to war. I could come up with a lot of interesting scenarios that could spike oil prices. We could have a war against Canada.
That's likely.
Yeah.
You dang Canadians up there.
I know. You never know. But I'm going to bring this up because when I saw this article, I decided to look up, okay, so what did and I don't have a particular beef against RBC. I know some of the people who work there. I know some people who wrote this. They're very nice, wonderful people. So this is nothing personal. Okay. This is just an example of why I think these kinds of predictions or forecasts or whatnot are not really useful. So I went back and I looked to see what RBC said about oil markets in the beginning of 2019. And I found an article by the same person, Michael Tran, talking about what they see, what he sees for oil prices. And I believe he says that, where he says exactly what he thinks the price. Here we go. We see WTI and Brent averaging $60 and $68 per barrel this year, respectively. While there is no shortage of captivating subplots ranging from OPEC policy to IMO to the role of U.S. oil exports reshaping global trade, this year could be one in which prices gyrate over short periods without providing compelling indication on long-term direction. Somebody get these people a thesaurus or take away their thesaurus, maybe. Gyrate. Prices are gyrating. It's like a middle school dance. Sorry. That's really probably inappropriate. So not to bring back everyone's horrible memories of junior high, but so in the beginning of 2019, they saw WTI averaging $60 a barrel and Brent averaging $68 a barrel. Now, we're in April and they're calling on $75 for Brent, and WTI is going to be at 67. That's a big change. So what's the message? Do we just ignore everything that RBC said in January and we should just wait for their April forecast, or what? I mean, like, did they somehow not foresee what happened in the past 3 months? 3.5 months? I mean, what's the message here? What should we take away?
I would really like to take someone like RBC and then maybe, some of the analysts that work for OPEC, and not the ones that are maybe putting out the message, but the ones who are actually just in there crunching the numbers, and just see what they think about some of this analysis. And because obviously you would presume that OPEC would have more potential information, and it just gets me thinking. We talk about the Saudis opening up their trading market. I wonder if part of what they're thinking is they see something like RBC and they internally believe that they're wrong, or consistently look at what they say and is wrong and go, you know what, God, we can probably make a lot of money here because people look at some of these other folks who don't have the inside knowledge that we do, and we can really capitalize on trading some of this product. Because I'm not saying the folks at RBC are bad people or anything like that, but if you had more knowledge and you're more right, if you're a trader, you're looking at RBC going, okay, this is what we think, this is how I'm evaluating my moves in the next few months. If the Saudis 3 months ago, theoretically speaking, looked at that and saw it, said, oh my gosh, they're way off, we can really capitalize if people kind of buy this narrative. The upside here for the Saudis could be a lot bigger than maybe I was thinking just a few weeks ago.
That is a very good point. I just wonder, I mean, how do people really find these forecasts useful? Because this is a huge change. I mean, say you're, I don't know, an airline company or something, and you're trying to decide how much money do we allocate to buying, jet fuel for 2019. And you look at the RBC's January forecast and you're like, okay, well, we buy jet fuel in the US and WTI is going to average $60 a barrel. So here's, how we, plug our numbers in. And now all of a sudden, 3 months later, they've changed their forecast and it's $7 more a barrel. I mean, right. I'd be like, you were feeding me. Like, how did you not foresee this? Isn't that your job?
Right. And just shorten the sentences down a little bit so we can follow along with what you're saying. But I got to give you credit here, Ellen. Since I've known you, which has been about 2 or 3 years now, you have been consistent on not putting a lot of stock into the predictions. Because they're so often wrong, and I don't think you've ever, maybe a time or two, I've criticized someone for not being on the up and up, but for the most part, your stance isn't that people are trying to mislead or be fraudulent. It's just that it's just so hard to predict the price of oil, and things happen, and we sit back and we go, oh yeah, well, we all knew that was coming.
Yeah, and I agree, it's really hard, but like people think that you can predict it. I'm a fellow at the Atlantic Council, and I had some people who were not involved in energy stuff, but were working on things in the Middle East, call me up from there and say, we're writing this report, blah, blah, blah. And we're wondering what's the, forecast for the oil market for, the next decade. And I'm kind of thinking, I understand why you think you want this, like why information like this would be helpful to you writing your report, but I don't know, and nobody knows, and anyone who tells you that they know what energy markets are going to be like or how much money Saudi Arabia is going to make selling oil over the next 10 years is lying to you if they say they know. Because we have no clue. All we know is it's probably going to be pretty volatile. That's basically the best I can say.
Right. And now, the only thing I'd push back slightly is it's hard to see, unless we find a lot more oil and a lot more nations start drilling, it's hard to see oil prices staying depressed, if you will, for long period of time, just because of the amount of development that has to happen around the world. So unless there's some kind of new radical technology, you feel like oil prices, or the demand for oil at least, will be there for the foreseeable future. And presuming that we don't just be able to drill it really cheaply, that should keep it might be volatile, like you're saying, but it should still tick up and to the right. You would think,
right? But who knows if someone's going to find? I mean, you never know. Like, we could find all sorts of new oil deposits or develop a new technique for extracting oil. I mean, like, I remember where we were in like 2003, and then no one could have foreseen this massive amount of oil that can now be tapped in Texas and Oklahoma and New Mexico. So who's to say that we won't have, we won't experience a similar thing that could cause oil prices to go down for a somewhat extended period of time? We just don't know. I think that's really,
we don't know.
We can't know. And
I guess the only thing, just to be clear, I'm more saying that the demand for oil, because there's some people who have articulated demand, the demand for oil will be there. So barring something like you're saying, it will, even the price goes down, unless some kind of technological or mass reserves come online, the price will rebound. Whereas with natural gas, I can't see the path to high natural gas prices anytime soon. It could happen, but it's kind of hard. So the demand for oil is not going away. A few years ago, that was kind of the peak oil demand was 2025, 2030, and I think we've kind of put that to bed finally.
Yeah, I do. I do agree that when it comes to oil demand, looking at the demand side, it's pretty clear that barring some sort of like incredible discovery or invention, oil demand is here to stay. But I just, it's just so. I understand why people want answers to that, but there is no way to know.
Right. And the other thing, real quick on this, we'll go to our next couple pieces here, is, and we talked about this before, I think, and I don't know how we parse this out, the oil and gas industry needs to get better about why is it telling you news. And so, for instance, like I said before, I'm more kind of read the news like I've been reading about the Anadarko Chevron deal, right? Well, that has more to do with what I think is going to happen in the Permian Basin as it pertains to, someone who owns a business who works in the Permian Basin and, does stuff like that. And sometimes these analysts are probably writing more towards traders, which is nothing wrong with traders. And so I think sometimes the messaging gets mixed on maybe who should be reading which article, because, if you're a trader, the price going from 65 to 70 is, a potentially really big deal. If you're a worker, it's probably not going to be that much of a difference. Now talking about maybe 45 to 50 or something like that, you could see it. But so sometimes we kind of lump all the news in together, and it's really probably a little bit better for different audiences to look at things a little bit differently.
Yeah, that's a good point. I agree with that.
Okay, now we got a piece from Bloomberg Opinion here, and I got to say I'm pretty disappointed. It did not label you as Dr. Energy, and so if we could help the editor there.
I tried. They're very particular about how they want to refer to people. What can I say?
I'm calling you out. Dr. Energy needs to be in here somewhere. But anyways, so Ellen put out a piece for Bloomberg Opinion, how Trump can escape a bind on Iran sanctions. The trick is stepping up the pressure without a spike in oil prices. Ellen, I'm not going to summarize this piece because you pinned it.
So I've people who have been listening to this podcast have probably gotten a sense of this, because I think I kind of talked out the idea for this op-ed on this podcast, which is maybe 2 or 3 weeks ago. Kind of took a while to get the ball rolling there, but the gist of it is that we're looking at a tighter oil market right now due to the fact that Saudi Arabia has cut production. We've got a fall in production from Kazakhstan, and we've got U.S. sanctions on Iran, and we've got U.S. sanctions on Venezuela that have really crippled their ability to export oil. And basically, the Trump administration can't have it all at this point. They can't have zero exports from Iran, of pressuring countries not to buy from Venezuela and cutting off Venezuela's oil exports, and low gas prices for the summer. It's just not possible. And in some respects, I was also writing against some of the more vociferous defenders of zeroing out Iran's oil exports, who will be unnamed because we're not that mean here. I'm not going to name names, but they've definitely written in the Wall Street Journal and other news outlets that they have to crush those exports to zero, and it just seems that's not going to, from the way I analyzed it, there's no political benefit to doing that for the Trump administration at this point, because in the eyes of Trump supporters, Trump fulfilled his campaign promise, which was to get out of the JCPOA. So they don't care whether Iran is exporting 500,000 barrels per day or 1.5 million barrels per day or zero. And that's for us oil nerds to parse out. And so they're probably pretty much satisfied that he's kept his campaign promise, and pushing those exports to zero isn't going to make Iran any more interested in coming to the bargaining table. It's probably not going to make them support their terrorist organizations any less. So, so why do it? Why threaten your Venezuela policy, which, by the way, I said long ago, I thought was quite ill-conceived at this particular point in time and hasn't yielded the results that the Trump administration wanted. I mean, Maduro is still there eating his empanadas. And so all it would do is to really tighten the oil market and probably push gasoline prices up. Maybe that's why RBC thinks prices are going to hit 80.
It's interesting. Spiegner, who left a review a while back on this show, he updated his on the Texas Oil and Gas podcast. And one of the things he said in his is that he's so tired of Trump's policy on low prices that he's not going to vote for him again. And and I thought that was interesting. And because you say in the piece here, Trump isn't wrong to be concerned about the price of oil. Global supplies are getting tighter and prices are rising. A few months ago, maybe last year, Trump was kind of on the prices are going up. You have the Saudis come out, increase production. He was blaming OPEC. Obviously, at the time, we kind of joked around that, he's putting the sanctions on Iran. And that was kind of hurting. The prices recovered some. Now the prices are, as you mentioned here, are rising again. What is the messaging? I mean, how do you take this? Because you point out the piece, he's got some problems with his foreign policy. What is the messaging here? Because if it's, the prices are going up. Okay, what do you want OPEC to do? What is there even a viable solution? He could pressure OPEC or the Saudis particularly to increase production again, or is that kind of out the window this time?
I really very firmly believe that that's no longer an option. The Saudis are like, you fooled us once, shame on me, fooled us once, but I'm not going to do it again. They definitely felt duped last time. They thought that the Trump administration was serious about pushing Iran's exports to zero. They increased production, and then he came through with all of these exemptions, and oil prices tanked, particularly in December. So they basically decided, I think, and I think you can see that because they were originally going to have a meeting in April, probably like either right, in like, it was supposed to be like next week or this week. It was supposed to be this week. And they were supposed to have a meeting where either they were going to see, maybe they were going to have word from the Trump administration, or they were going to make policy. They were hoping to get some sort of information from them. We know that OPEC speaks and has had like updates come directly from Brian Hook, the U.S. envoy on Iran or whatever they call it. So it definitely seems like they were wanted to kind of wait and see what the Trump administration was going to do. And now they've clearly decided, no, we're not making our policy around them. We're going to do what we want. Saudi Arabia was like, we want to cut our production. That's what we're going to do. And, if Trump decides it wants to zero out Iran's exports too, well, by golly, we'll take the higher oil prices. It's not going to hurt them. So, and I don't think that they are going to be susceptible to that kind of pressure, having been duped once.
Yeah, and just real quick, I don't know if you saw, and I haven't, this was when the baby was coming, so I didn't get to follow the news. I know Congress passed some sort of resolution to pull the troops out of Yemen, and I heard Trump was thinking about vetoing that. Obviously, with the U.S. not so, if that, I don't know where that ended up landing. I didn't get to follow the story, but if the U.S. does pull the troops out of Yemen, that would seem to, whatever leverage Trump does have, would diminish it without us fighting alongside them in Yemen as well.
Yeah, I don't think we're actually fighting in Yemen. I know that we're like supplying we're either supplying missiles for it and guidance or something like that. So, but yeah, it's an important component of the Saudi, the Saudi strategy. So that definitely would not be good for that. It's, I think he's really messed it up here in trying to push Venezuela and Iran's exports to zero and use it as this important component of foreign policy. You can't do it everywhere at once. The U.S. does produce a lot of oil, but it's not. You can't just cut oil exports from all these places and expect the U.S. to be able to fill in everywhere.
Yeah. Well, and on the forces, I'm not sure exactly the balance there. I know that I think it's Trump's first State of the Union address, he had the wife of a fallen Navy SEAL who was killed in Yemen. So I took that to presume that we did have at least some special operators.
That's a good point.
In Yemen. So I don't know. It could be. We obviously are backing them in other ways. I don't know how many troops we actually have.
And you know what? We may not even know. Like we sometimes I'll see these reports like, troop killed wherever, and I'll be like, I didn't even know we had troops there. So they've got a good point.
So yep. Anyway, regardless, support troops, whatever, could change the Saudi-U.S. relationship. Well, once again, for his monthly return to the show, we have on Dr. Dean Foreman, the chief economist with the American Petroleum Institute. Dr. Foreman, I know we had some technical difficulties, so thank you for being patient with us and joining us again once this month. How are you doing today, sir?
Doing great. Ryan, Ellen, thanks so much for having me. It's always a good conversation. Thank you.
All right, well, let's get into it. We have the report, which we will link to, which will be coming out on Thursday, I believe, the 18th. Today's the 15th, so we will link to where you can download that report in the show notes when it comes out on Thursday. This is for March. Let's just talk real quick about demand. Solid U.S. petroleum demand in March, but growth slowed to 0.4% year on year. Is that just from looking back at your historical reports, it slowed some, but was this kind of where you felt it might fall into this 0.4% growth, or was it a little higher, a little lower than what you were anticipating?
Definitely lower than expected. And, there are a couple of factors at play here. One is that we've really enjoyed sort of above trend growth over a relatively long period of time, extending into last year. And even if we looked at February, it was above 3% year on year, which can't last for an entire year. But my goodness, if you start looking at 0.3 and 0.4% for oil demand growth, that's kind of a long run, with a lot of efficiency factored in kind of change. So again, let's take some of the monthly noise out of this, but it is slower than expected.
So it seemed like what you were saying is, don't read too much into this slightly slower growth. It's still quite high. Demand is quite strong. Maybe you could talk a little bit about your economic indicator, the API economic indicator, and what it's telling us about what we can expect in terms of industrial growth.
No, thanks, Alan. It's a great prompt in the sense that we're really trying to figure out what's going on here. You've got conflicting signals in that the absolute numbers, that the levels of demand are, highest in 14 years in many cases, and some are still near records. But then at the same time, we've got this drop in exports, and when we start looking at diesel fuel or distillates in particular and what's happening with those, where we see some weakness. The slowing growth actually in distillates and gasoline and in jet fuel. The distillate part of that, along with some other industry indicators, go into it's API DEFI, the distillate economic and financial indicator. And to make a long story short, this composite indicator turns this into something that weights the fact that the demand slowed, the inventories grew, the prices went up a little bit, and interest rates went up a little bit. And when we start weighing those factors in, what we see is that something that has a pretty remarkable correlation with U.S. industrial production in total has been telling us correctly, actually, for the last 4 consecutive months that the year-on-year growth in total industrial production would slow. So this is a pretty good indicator of where the industrial part of the economy and, in general, economic growth are likely to head. And as we put the whole story together and then corroborate that with what's happened on the export side, it starts to look like a broader economic story, both for the U.S. and globally.
So, so that kind of goes in line with what we've been talking about the past couple weeks on this podcast, particularly about what is happening with the yield curve and how that's indicating slowing economic growth. So it does seem like these indications are aligning. One of the things I wanted to talk about was inventories, and the reports is that oil inventories are still high. They've increased, I think, 6.4% year to year, and 4.7% higher than the 5-year average. So we're seeing oil inventories growing, and yet we're also seeing rising oil prices. I was wondering if you could comment on perhaps the correlation between that, or are we at a point where there really isn't any correlation between those anymore?
Well, there definitely is an aspect in which the inventories and the reading of those from week to week of how those change does impact prices and trading and planning in general. Now, what we're seeing here, though, is we're questioning whether, one, it's signal versus noise, and two, whether it's a big enough signal that we're getting out of it. A 6.4% year-on-year change is consequential. Being above the 5-year average, but still relatively in the middle of it, helps. And keep in mind, let's go back, if we rewind to this time last year, we were concerned that inventories were actually running lower and that prices were rushing up in the early part of the year last year. And here we have, with some OPEC management of the price, we have some things where on the international side, the prices have been buoyed up by the production cuts out of OPEC Plus, including Russia. And as the inventories here, we're just getting a read really on the United States and not the global picture on inventories, which frankly, outside of OECD nations, doesn't really exist with any precision. So we have a partial indicator, and it's the best one that we've got. And it says that the inventories are growing. And if they continue to grow, then the market will eventually take notice and catch up with that. But it has to see enough of this to really say, yeah, that's signal, that's not noise.
So, which is interesting because a lot of the banks right now are they're all, hurrying to revise their forecasts for oil prices. We were just talking earlier on the show about RBC Capital, and they've revised their forecast. Earlier, they were calling for $60 average for WTI this year and $68 for Brent, and now they've upped that to $67 for WTI and $75 for Brent, with us possibly hitting $80 a barrel at various points this summer. It seems like everyone's rushing to I think I heard that maybe Bank of America saying, well, it's not impossible that we could hit $100 dollars a barrel this summer. What does the actual data tell us? How likely are these kinds of forecasts? Are they rushing ahead too fast?
Well, from an API perspective, it's hard to pass judgment on anybody's forecasts in particular. But when we look at what EIA did, the Energy Information Administration, revised its official forecast as well. And instead of $60, they're around 62. They went up a little bit. And look, based on market tightness right now and the fact that OPEC's reductions seem to have stabilized the oil price, it's not unusual that you would see these kinds of revisions coming out of the bank sector. But again, as this shifts, let's back up to the macro story. If we zoom out and say, what's happening with the US dollar? What's happening with interest rates? And we've got a chart in the back of this monthly statistical report that's a new one that plots out for every quarter going back decades on what's happened between the US dollar, the strength of it, and the foreign exchange rate on a broad basis as measured by the US Federal Reserve versus Brent crude oil prices internationally. And as you might expect, it's an inverse relationship where if you've got a stronger US dollar in the last decade or so, we've tended to see lower Brent oil prices as a result, and WTI in conjunction with that. So roughly, we have the US dollar within a sliver of its strongest exchange rate value in a decade. And that adds additional downward pressure to oil prices, coupled with the fact that the U.S. Federal Reserve and its policy decision this month is basically on hold, and it's signaled that it's not going to raise the Fed funds rate this year and is likely to look for next year. You have a lot of the investment banks, at least on the economic side, coming out and saying, look, they don't expect anything out of the Fed till 2021, many of them. So if you're on hold as the Federal Reserve, you're basically saying the rates that you have are policy neutral. Frankly, hot money chasing relative interest rates is one of the biggest impacts on the dollar's foreign exchange rate value. So if that takes some of the air out of the dollar, if the fact that you're not raising interest rates and that it's neutral means that the economy is basically kind of humming along but not overheating, and it's not needing help with lowering interest rates, that sort of says that you'd kind of expect the oil market to respond in tandem. So the really bullish tight market, we can always create scenarios off of it, but that's the way I would box it in. It's trying to triangulate what are the signals we're getting from the macro economy with the oil markets. And to me, it seems relatively copacetic.
I have one more question, which is kind of a very far out picture. But one of the things that we learned recently was that Saudi Arabia wants to double their refining capacity to 10 million barrels a day by 2030. But they have no plans to double their oil production. So it seems like Saudi Arabia's plan is to export less crude oil and keep more of it home and to refine it into products and then sell those. And that means fewer crude oil, less crude oil out in the world or being exported from Saudi Arabia. What do you think that means for U.S. crude oil exports? We know that our product exports are generally quite strong, but what are the chances that maybe the U.S. will be able to take over or increase its own exports given this policy? I know this is kind of a long out picture.
No, it's a really fascinating question, and that everybody kind of has the same business case, right? So if you're Saudi Arabia at the same time as you're making a lot of noise about wanting to diversify the economy off of oil, here you are saying, okay, it's not going to be just oil production. It's going to be the value add off of that, right? Refining petrochemicals, either taking a position in SABIC. It's still related to what they have as an endowment of resources, but it's building off of that. And the problem is that the U.S. has it, Russia has it. The shale oil and shale gas are pretty widely diversified globally. So as we start planning forward for a refinery and such, you really have to look at a 25-year plan to figure out if this thing's going to hold water. Frankly, the capital that's going to be required, if you're already running a deficit of Saudi Arabia, it'll be a challenge to get what they need to rush into that and to be cost competitive when the U.S. as a refining base is as cost competitive as anything in the world right now. So as a whole, as the U.S. is doing so well with an advantaged feedstock in light oil coming from shale, that just like in the petrochemical market, if you start adding big blocks of refining capacity all at the same time, it tends to have an impact on the prices and margins. So, how many of these you can build, how fast, it's great to have the vision, but just the constructability and the marketability of what you would get out of those large additions, given that India is building refineries, Asia Pacific writ large is trying to expand its refining capacity. The U.S. is. Mexico wants to have domestic refineries. If everybody goes that direction, we could start to tell a story about deglobalization in terms of trade flows, and that would be fascinating. But it will be difficult for everybody, including Saudi Arabia, to execute wholly on that vision.
That's a really interesting perspective that I didn't consider. Now we'll turn over to Ryan.
Well, I really just have one thing I want to talk about, because it was funny. The last time we had you on, we were talking about the impact of the 737 Boeing Max plane, and you said at the time that just to kind of recap, the plane crash had just happened, and there was a little bit of rumbling, and then like the next day after the show dropped, all the news about the groundings came out. So let's kind of go back over this past month. How much impact has that had on what we're seeing with jet fuel? And then it seems like kind of what's happening with these planes is up in the air. Do we expect that to cause any kind of constraints or price fluctuations over the summertime, or is it not really that severe of an issue right now?
It's certainly a severe issue for certain airlines in terms of their ability to execute and have the fleet of aircraft that they need available right now to handle peak summer travel, peak Christmas time travel, holiday travel, what have you. And from an overall market standpoint of is it deterring air travel? Is it deterring fuel consumption? We're still seeing at 1.7 million barrels per day, really strong and solid, kerosene type jet fuel consumption. But the growth on it again has slowed, consistent with these other fuels. And at the same time, there's no doubt that this is having at least a minor impact on that. The other side of this, though, is that when we look at the International Association of Air Travel, we're seeing that their reports of passenger kilometers or miles traveled have also decreased in growth, not declining, but decreasing in growth. And that, because this is such a strong contemporaneous economic indicator, does tend to tell us something about how people feel about, frankly, their income and their spending and their confidence in the economy.
So if I'm reading between the lines here, maybe I'm not in the picture. It feels like what you're saying is it seems like there's we have seen a little bit of decrease in growth, as you said, but it's not really related to the groundings. Obviously, there's probably a few people who aren't flying anymore, but it's just kind of the normal ebb and flow of the economy, and the grounding hasn't had a wide-scale impact other than maybe some more tighter markets for certain airlines. Is that a correct summary?
I think that's about right. On the margin, there probably is some negative impact in the sense that you're going to have some individuals who are actually concerned about flying certain aircraft, and if there's not an alternative flight available at a reasonable cost, may choose some other mode of transportation or not to fly at all. But outside of certain airlines that have had to ground significant portions of their fleet as a result of this, the overall macro impact should be relatively small.
Okay. And the final thing here, we'll wrap up with this because we're up against the clock, but as we go into the summertime, obviously President Trump has been talking about, deals with China and getting that kind of wrapped up. We'll see if he's successful or not. Obviously there's tension in Venezuela between now and next month. What are some of the things that you guys, obviously you have the things in the report that you monitor, but what are some of the headlines or news topics that maybe the listeners should be watching for as we get ready to go into the summer driving months?
Well, we're really looking carefully to see what happens out of the prospective China trade deal. Clearing the clouds on those could have a big impact both for our markets, exports of crude oil, of natural gas liquids, and of liquefied natural gas, all of those, but also just generally how consumers are feeling. And a lot of we talked in previous podcasts about what happened with global shipping rates as a result of global trade being slowed by these frictions. If that could clear, that would help a great deal. So that's really the first thing that we look for.
Okay. I know I said this, but one final question. IMO 2020 is getting closer by the day. At what point will we see headlines that those new rules and regulations might be impacting prices?
Well, it's interesting. Buried in the report, we're monitoring what's happening with residual fuel oil, which is the higher sulfur fuel oil that gets used in the marine sector, among some others. And there's no doubt that the demand for the higher sulfur fuels across the board has continued to decline. You wouldn't expect strict compliance with IMO 2020, which really kicks in January, until it happens. And you've got people on both sides of it saying, look, the sky could fall, that you could have a big price impact, it could be a 20% price impact. I heard one consultant recently saying, and look, there may be some short-term price impact, but we have to keep in mind that investments have been made, large ones, to try to increase the amount of diesel fuel that's going to be produced as the sulfur specifications, just to backtrack for a second in case the audience isn't completely clear, as the sulfur specifications kick in, it's going to take the higher sulfur fuels out of the marine bunker market and replace it with low sulfur distillate, low sulfur diesel, those kinds of fuels. So on a global scale, we've seen precedents in the past where the market's adjusted to these kinds of changes, where the entire market for all marine fuel is on a global basis, like 3.5 million barrels per day. And again, this has been planned for years. People have seen this regulation coming since 2008. So it's only news because we're hitting close to the deadline now. And as we crawl closer to it, the market will have to adjust. Scrubbers will have to be installed on some ships. The compliance is actually the key variable. We expect strict compliance in the United States and Europe, possibly Singapore, but we'll have to look at the rest of the ports around the world to see how strict they are at day one of starting to implement this. Because if fuel is still available, it's higher sulfur and can be burned, say, from ships going from emerging market to emerging market, all of this ties together in kind of a cohesive way. So we should expect the compliance to increase over time. The question is how strict at day one and what that might do to short-term prices. I'm guessing the market's pretty resilient, and after a relatively short period, this should be something that works itself out.
Okay, great. That is a good recap of this past month and some things to look ahead for as we get into summer driving month and the official summer. We were talking about that earlier, which is in, late June, I think, Ellen. So anyways, Dr. Foreman, wonderful as always. We're going to link to this report, which comes out on Thursday, April 18th. You can go to api.org, and I'm on the website now. Looks like y'all might, hold on, I don't have it full screen. There we go. On the top right, it says Chief Economist. You can click there, and from there is the industry outlooks and other releases from the API. Dr. Foreman, is there anything that we missed today that you wanted to touch on before we got you out of here?
No, this is great. It's just a really interesting and pivotal time for energy markets. So I really appreciate the timely questions. Thanks so much for having me.
Yeah, thank you, and thank you for working through our technical difficulties on our end, and we look forward to having you back. God, it's hard to believe to say this, but in May. And so I was looking the other day, I think your first appearance on the show was August, so we'll be at our 1 year anniversary with having you on just around the corner. So thank you again, as always.
Oh, you're very welcome. We'll have to find a way to have a virtual beer or something.
Okay, and that is Dr. Dean Foreman, Chief Economist for the American Petroleum Institute. Be sure to check out all their work at api.org. We will link to that in the show notes. Ellen, any final thoughts from Dr. Foreman's report or anything else we talked about today?
I liked the way he summed it up with this is a very interesting time for oil markets.
Okay, and with it being interesting, I'm sure Dr. Energy will be out there espousing the proper view on energy. Where will she be?
Let's see. I will be on investing.com later this week, and probably on Forbes as to be determined. No big interviews lined up this week. Hopefully keep it a little quiet because I've got some longer term writing projects I'm working away on.
Okay, well, I will be on Rush Limbaugh and Sean Hannity spewing right-wing propaganda.
I'll be sure to tune in because, as we all know, I too am a right-wing propagandist.
Texas Oil and Gas Podcast, Oil and Gas Contractors Connect. Next week, I will be at the Texas Energy Alliance Producers Conference in Wichita Falls, Texas. So if you're up that way, give me a shout. Ellen, great show as always. And to listeners, we'll talk to you next week.
Bye-bye.